Welcome to our High Rock monthly video for August. I am Scott Tomlinson, and with me on the call today is the portfolio manager, Paul Tepsich, who founded High Rock in 2010. We started our private client wealth management division in 2015, and we are coming up to our 10-year anniversary. If you are interested in learning more about us, visit our website at highrock.com. Yeah, .ca, that is, highrock.ca. Okay, Paul, July was a pretty good month for all asset classes, some better than others. Canadian equities doing quite well. Global equities not quite as well, but everything was in a positive way. So that definitely helped balance portfolios move higher over the course of the month. And that's always a good thing for our clients because we have the bulk of our clients in balanced mandates. Anything you want to add about July?
Yeah, well, the only thing I would add about July, and takes us into early August, we're recording this on August 8th, is that, we pretty much hit the high watermark, the new highs for many of these asset classes, and most certainly for our client portfolios. And as of July 31st, we kind of all went up, the markets went up, and our accounts went up, and we rang the bell. And maybe Scott will talk a little bit later about what has happened in the first week of August.
So we will. And as you say, it was pretty much ringing the bell of the high water mark. If we look at the Morningstar averages of their global balanced funds, we can see that they've fared quite well. Any clients that want to compare their performance with this average performance, you're welcome to get in touch. I think we have pretty good news on that front for you up until, as Paul said, July 31st. It's been a bit of a different story in the first little bit of August. We will get to that shortly. Paul, let's, before we get there, talk about anything that you might want to add with regards to our special mandates.
Yeah, we'll start with prefs. They continue to have a decent month in July. As mentioned, we've had a couple of our bank prefs that were redeemed. That trade is largely played out. So now we've got still some decent value in a couple of rate resets, and moving more towards some fixed rate, given what we hope is a rate cut program that the Bank of Canada is now on, having cut twice at two times 25 basis points. So fixed rate, probably the way to be. And that dovetails nicely into high yield as well. Owning some fixed rate corporate bonds, I think, is as long as we don't go into a major recession, is the way to be. And again, in high yield, there's again more of a coupon year. If we can pull out 6-7% type coupon yield, that's pretty good. And just to add, the only trade we did in high yield across the month was we added a new issue, which is Athabasca Oil. This is a pretty interesting company. I've had a really good investment / trade in this back in 10 odd years ago, and I hadn't done anything in this company in quite a while. But this bond came up, and just compared to the various competitors around it, small, intermediate size players, oil and gas producers, that is, this company is sitting on a net cash position. So that means they hold more cash in their balance sheet than they do debt. And this bond came at a 6.75% yield, which, given that capital structure, that debt structure versus the cash, I think it's pretty damn good. And there's no bank debt ahead of us, or senior to us, if you will. So that bond, unsurprisingly, we got very, very lucky / smart when we bought it on a new issue basis because it was probably 5 times oversubscribed, but we ended up getting what we needed, which was fabulous. So I was quite happy with that. Not surprisingly, the bond traded up in the secondary market when it was free to trade. So hopefully that makes some sense to our clients. But suffice to say that that seemed like really good value to us. That's it, Scott.
All right. And speaking just briefly about the Bank of Canada, while you're on that, brought that topic up, it is quite possible that the Bank of Canada will cut again in September, and then again each time they meet for the rest of the year by 25 basis points. It appears the Canadian economy is slowing fast enough, and that inflation is under control at the moment. That's what we see, which leads us to believe that there will be continued rate cuts coming as we go approach the end of 2024 and certainly into 2025. The U.S. Federal Reserve, Paul, you can correct me if I'm wrong, certainly in all likelihood 25, maybe 50 basis points in September. And then again, depending on how their economic picture looks and their inflation picture looks, there may be more to come. But given that it's an election year, the Fed may want to step back until after the election.
Yeah, I totally agree in Canada, and I think the bank cuts every meeting they have by 25 basis points, unless something breaks in the market, like it looks like it did over the past week. And again, we could talk about that in a second. But and same with the U.S. I think the Fed's not going to go more than 25 in September, but both economies, certainly Canada. Um, I think the central banks, both Canada and the Fed, have moved from worrying about inflation to now worrying about the employment and the economic situation being weaker than they had suspected. So that's I think rates are coming down here pretty substantially. So
Yep. Okay.
that's why we like owning fixed rate debt, both in the prefs, in the investment grade corporate bonds, and in the high yield bonds.
Excellent. And we often talk about how our focus is on our clients' long-term goals, but obviously we have to look for short-term opportunity in the markets, in the financial markets, and that's what we're scouring markets on a daily basis for. And let's talk a little bit about what we've seen in global equities over the last few days. As we alluded to earlier, there's been a fairly significant pullback in global equity prices. A lot of it has had to do with the fact that hedge funds have had what we call a carry trade on, where they have borrowed very at very low interest rates in Japan, so in Japanese yen terms, converted that money to other currencies on a worldwide basis, and then used that cheap money to buy global assets, global equity assets, in this case. When the Bank of Japan decided that they might raise interest rates, all those people that were very heavy into the carry trade, which Paul, I don't know if you have numbers on that, but in the billions for sure, maybe even more, got a little anxious and started to decide that they were going to pay down their Japanese yen debt, which meant they had to buy Japanese yen, sell other currencies, and at the same time start selling equity assets, global equity assets, among other assets. So interestingly enough, we've seen a fairly significant pullback, and we always have a peek at this metric here, this fear and greed index, and it always has been pretty good at telling us when there are good times to be buying. And in times of extreme fear in this index, those have been prescient times to be able to add assets, add equity assets to portfolios. So in the past, I've talked about how we've been rebalancing as markets hit their highs, taking some cash off the table, and looking for other opportunities. Well, in the last few days, those other opportunities have presented themselves. We have been aggressively buying equity assets for client portfolios who we had raised cash for, or if they had added new cash recently, taking advantage of the pullback in equity markets. So that pullback may not be over. So we haven't put all the money to work. We still keep some powder dry, but we have added a reasonably significant amount of equity assets if clients needed them. Paul, any comments?
No, I would just add too, the Bank of Japan did hike rates, and they did so. Part of the nervousness, I think, in the big unwind with this so-called carry trade was they hiked rates with a weakening economy, and that kind of flipped everybody out. And the other thing, I guess, about on the rate side is that, the markets in North America are certainly in the US thinking that perhaps the US Federal Reserve, their central bank, is behind the curve, meaning that maybe the economy and the employment situation, which we got their employment situation numbers last Friday on whatever that was, August 1st, and that flipped the market out too because it looked like the employment situation was much weaker than expected. And the markets have been over the past week putting pressure on the Fed to cut rates and perhaps even an emergency cut. Now, over the last couple of days, or certainly today, the markets have calmed down and stabilized and actually gone up. And I don't think the Fed's going to cut rates before the September meeting, not unless something really does break. And when we talk about something breaking, it really is more about, it's not just weakness in the equity market. It's just more about the ability for short-term funding to dry up, because that's what moves the economy. It's 30 to 90-day funding instruments for corporations, for banks. So if that dries up, that's really something breaking. So, the equity markets being down 10% in a couple days is bad, but it's not a seizing of the credit markets. So that's it.
Excellent. Thank you. And while we're now finished with global equity, I'll pass over to you, Paul, to talk about the tactical model.
Okay. There were really no trades in the tactical model. I'll just highlight one good and one not so good. The first one that is good is our position in Source Energy stock. Just by background, again, a refresher. It's this company basically mines northern white sand in Wisconsin, trains it up to the Western Canadian Sedimentary Basin, and then has like a logistics business where they distribute it to frackers and drillers and also the oil and gas companies themselves. And this company restructured their debt a number of years ago. I think it was 2020. And I love situations like this because they have a cleaner balance sheet. And over the past year, the company has had, the best current performance, and the best visibility they've had ever since I've been looking at it, which has been about 8 years. So again, refresher, we owned this bond for a number of years. It was a spectacular trade for us, and we sold that bond in our balance mandates. We still own it in our high yield mandates. We sold it in a balance mandates in favor of buying the equity. The equity, we ended the month, July, it's very volatile. We own it in a commensurate size because of its volatility. But we ended the month, we were up, since we bought the equity about 2 months ago, we were up about 50%. Today, yesterday we were probably only up about 25% from where we bought it, and today we're up about 35%. I think this company is going. What I'm waiting on is they have a bond due, the bond we own, we used to own, and our high yield guys do, that's due in March 2025. Uh, the market is a little bit, not a lot, but a little bit nervous about that bond and how they're going to refinance it. I believe they will do so no problem, either with some banks or extending it, or it won't be a problem. The bond's trade at par, which is good. And once they do that, I think the stock is shoot up north of $15. And quite frankly, I think this company would be taken out at $20 or north of that. So it's trading at a very cheap multiple, given the outlook they have. So that's the good news. The not so good news is just to mention our position in Sherritt stock, which we've owned for 2.5 years. That turned in from a shorter 2-year type trade to now a longer term trade, given what's happened in the battery metal space, that being mostly nickel and cobalt. Even their other byproduct of refining those two metals in Alberta is fertilizer has been hit hard. Every metal, including copper. There was a story out last night about copper inventories in Asia all-time high. So the whole electrification theme is people, I'm sure, have read about electric vehicles. Demand is growing slower. It's still growing, but it's growing slower than one would have expected 2 years ago. So we need the price of the metals to improve rather substantially here, and that is going to take more time for sure. So lots of things on the go. I did meet with the CEO and CFO last week. If anyone has any questions on Sherritt, it is a very complicated file. They are welcome to contact me directly. That's it for tactical, Scott.
Excellent, thank you. Anything to talk about in the fixed income model?
Yeah, the only trade we did here, and not in July and June, we sold both of our Commerce .O bank preferred and TD.B as in Bob. Sold them both in late June, and we took those proceeds in July and we rebought some of our government bonds, a 2-year Government of Canada bond. So, and that actually has worked out okay, given that rates have come off a bit here. Rates have gone lower, prices higher. So we just redeployed that capital, and that was really about the only trade. And high yield and investment grade seem to be holding in quite well so far. So they had an okay month as well.
Excellent. And that has provided some pretty good balance for our portfolios, as some of the equity positions have come down in price. As we've seen the volatility over the last few days, the balance in fixed income has mitigated that downside for balanced portfolios, so that your portfolios have not been battered by the volatility that we've seen in equity markets to the same degree.
That's the idea.
Absolutely. All right, that's it for our financial report. Just a reminder that High Rock sponsors and financially sponsors a couple of elite athletes. One of them, Finn Gilbert, who's an under 16 hockey player, was in a tournament in Boston last week. There's quite a showcase for up and coming potential junior players, college players, and word to me has it that he played extremely well, and it has had some eyebrows raised and interest mentioned to him from a couple of situations in the States and in Canada. So that's very positive. And Miranda Tomlinson continues her pro triathlon season and has moved her way up in the rankings to be number 7 in Canada, number 160 in the world. So she continues to plow forward in that, and has still a number of events right into November. So anyway, that's just a little update on the athletes that we sponsor. And as always, I want to take this moment to thank you for taking the time out of your schedules to tune in. We'll be back with our next update at the beginning of September. Until then, this is Scott Tomlinson on behalf of Paul and my other colleague Diane. We want to wish you all the best for the month of August.